Owning assets outside the UK does not automatically remove them from the UK inheritance tax. Many international British families assume that once wealth is held overseas, it sits outside the UK tax net. In practice, this may not be true. Assets located in different countries can still fall within the scope of UK inheritance tax, depending on domicile, ownership structure, and how those assets are legally held. This creates a structural issue. You may hold property in Dubai, investment portfolios in Singapore, and business interest in Europe. Yet all of these assets can still be assessed together for UK inheritance tax purpose. The practical consequence is that liquidity planning becomes difficult, succession becomes fragmented, and families can face tax exposure on assets that are not even located in the UK. My name is Shiraz Fahid and I'm the co-founder at Liquidity Wealth. And in this video, I'm going to explain how UK inheritance tax applies to overseas assets, what foreign asset remains exposed, and how proper structuring can help reduce UK inheritance tax exposure. The starting point is understanding that UK inheritance tax is not only based on where the assets are located. It is primarily driven by domicile and long-term connection to the UK. Under the current rules, individuals who are UK domiciled, deemed domiciled, or treated as long-term UK residents can still fall within the UK inheritance tax framework on their worldwide assets. This means overseas properties, foreign bank accounts, offshore portfolios, and shares in non-UK companies may still be included when calculating inheritance tax exposure. This often surprises international British families. You may have lived abroad for many years and built wealth entirely outside of the UK. However, if UK domicile still applies, those overseas assets do not automatically sit outside the inheritance tax scope. The UK looks at individuals and their estate, not just the physical location of the assets. The complications increases when assets sits across multiple jurisdictions. Each country may have its own succession rules, probate process, and ownership documentation. While the UK may apply inheritance tax, the local jurisdiction may still require separate legal procedures to transfer ownership. This creates both tax exposure and administrative complexity at the same time. Another important change is that UK inheritance tax is moving away from purely domicile-based concept. Under the new framework, the long-term UK residents can also bring worldwide assets into the scope. This means individuals who have lived in the UK for an extended period may remain exposed to UK inheritance tax on overseas assets, even if they later leave the UK. In practical terms, someone who spent many years in the UK, built wealth overseas, and then relocated may still fall within the UK inheritance tax net for a period after departure. This creates a tail risk. Assets held outside the UK may still be assessed together with the UK assets depending on the residency history and timing. This changes the planning assumptions. Previously, many families focused primarily on changing domicile. Now, residency history, timing of departure, and when structures are implemented all becomes relevant. Overseas assets are acquired after leaving the UK may still be exposed if long-term residence conditions apply. Because of this, inheritance tax planning involving overseas assets require coordination before and after relocation. Ownership, design, governance, and timing all influences whether foreign assets remain connected to the UK inheritance tax framework. Beyond taxation, overseas assets introduce a control and continuity risk. When assets are held in your personal name across multiple countries, each jurisdiction may require a separate probate process. This can delay access, restrict control, and complicate succession. For example, a UK domiciled individual may hold properties overseas, a foreign brokerage account, and shares in private company. Upon death, each of these assets may require separate documentation, local legal procedures, and in some cases, court involvement. While this is happening, inheritance tax exposure may still apply at the state level. The result is that families face both time pressure and tax pressure. Liquidity may be needed to pay inheritance tax, but assets may be frozen during probate. This mismatch is where estates face difficulty. It is not only the tax rate that matters, but also whether assets can be accessed in time. This is why governance and control become central. The way assets are held can determine whether succession is smooth or fragmented. Holding assets offshore does not automatically remove inheritance tax exposure. Many investors use offshore companies, foreign brokerage accounts, or international holding structures. These can provide administrative efficiency, but they do not necessarily remove the UK inheritance tax exposure. If the individual remains UK domiciled and owns those structures personally, the value may still be included within the estate. The UK tax authorities looks through ownership layers when assessing inheritance tax. This means an offshore company holding foreign property may still be considered part of individual's estate depending on how it is structured. This is where timing and intent also matters. Structures implemented late or purely for tax avoidance without proper governance may not achieve the intended outcome. Proper planning usually involves long-term ownership design, clear governance rules, and separation between personal ownership and asset control. Another practical issue with overseas assets is liquidity. Inheritance tax is generally assessed on total estate value. However, overseas assets may not be easily liquidated. Property may take time to sell. Private investments may not be transferable quickly. Foreign bank accounts may require additional documentation before release. This creates a timing mismatch. Tax may be due before assets can be accessed. Families may then be forced to sell assets quickly or use personal liquidity to meet the obligations. This is particularly challenging when assets are spread across jurisdictions with different legal processes. Banking institutions also apply their own procedures when an account holder passes away. Accounts can be frozen pending documentation. Some banks require local probate recognition. Others may request notarized documents across jurisdictions. This adds delay even when assets are liquid. Because of this, inheritance tax planning involving overseas assets must also consider access and control, not just the valuation. A coordinated structure can help address both exposure and succession complexity. The objective is not to eliminate tax automatically, but to create continuity with governance across jurisdictions. When assets are centralized within a properly designed structure, ownership and control can be separated. This can reduce probate fragmentation and creates a single succession framework. It also allows coordinated decision-making and smoother transition of control. This type of planning becomes more relevant if wealth becomes more international. Multiple properties, cross-border investments, and foreign operating companies create complexity when held personally. Structuring introduces governance and continuity rather than leaving succession to separate legal system. Jurisdiction choices also matters. Some jurisdictions such as Cayman, UAE, Jersey, and Singapore provide structured foundations or trust frameworks designed for international families. These frameworks focus on governance, control, and long-term continuity rather than secrecy. The emphasis is on regulated structures that coordinate ownerships across assets. Another approach used by international families is building investments within an insurance wrapper from the outset. Instead of holding assets directly in personal name, investments are acquired inside a life insurance policy issued by an international insurance provider. The policy becomes the legal owner of the underlying asset, while individuals hold the policy. This changes how assets are viewed for inheritance tax purpose. Depending on the structure, resident status, and policy design, the wrapper may sit outside the individual's personal estate. The investments inside the insurance policy wrapper can include portfolios, funds, discretionary mandates, properties, and in some cases, private assets, all held within the insurance structure rather than personally. This is particularly relevant for families who are still building wealth. Instead of restructuring later, investments are accumulated inside the insurance wrapper from the start. Over time, the portfolio grows within that structure, which can create separation between personal ownership and investment assets. The objective is to design ownership in a way that may keep those assets outside the regular inheritance tax criteria, subject to domicile, residence, and policy terms. The insurance wrappers can also help cross-border coordination. International families often move between jurisdictions. Holding assets directly may trigger reporting, restructuring, or ownership complications when changing countries. A properly structured wrapper can provide continuity because the policy remains the asset, while the underlying investments can change within it. Governance also becomes clearer. Beneficiaries can be defined within the policy. Succession can be structured contractually, and transfer on death can occur through policy terms rather than multiple probate processes. This can reduce fragmentation where assets are otherwise held across different jurisdictions. However, structure and timing remain important. The wrapper must be implemented before assets are accumulated, and policy design must align with residency and long-term planning. Not all insurance policies achieve the same outcome, and jurisdiction of the insurer, ownership design, and beneficiary structure all matters. Banking and custodian acceptance should also be considered, particularly when holding discretionary portfolios or non-standard assets. Timing plays an important role when using insurance wrappers and cross-border structures. These arrangements are generally most effective when implemented before significant assets are accumulated. Moving assets later can introduce tax, reporting, or banking complications depending on jurisdiction and residency position. It is also important that wrapper aligns with broader structuring. Families may combine insurance wrappers with holding structures, trust, or foundations. Coordination between these layers should be designed from the beginning so the governance and control remains clear. Without coordination, structures can overlap and create administrative friction. Banking and custodian acceptance should also be considered early. Some portfolios can be transferred into the insurance wrapper, while others may need to be built within the structure from the start. Investment flexibility, reporting requirements, and cross-border movement should all be reviewed before implementing. Investment flexibility, reporting requirements, and cross-border movement should all be reviewed before implementation. Ultimately, UK inheritance tax on overseas assets is less about where assets are located and more about how they are owned, governed, and coordinated. Without structure, overseas wealth can remain fully exposed while also creating succession complexity. With proper planning, families can reduce potential inheritance tax exposure and create a smoother transition of assets to the next generation across jurisdictions. Now, if you want our help and would like to explore whether these structures fits your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.